Well, as a result of rising interest rates, one of the hottest areas of financial markets has not been in public equities or even public debt. It's been in private credit. Joining us now to discuss the underpinnings of this boom and whether it can continue, let's bring in Dan Zwirn, CEO and CIO at Arena Investors. Thank you so much for joining us, Dan. For the uninitiated, just explain kind of in layman terms what we're talking about when we talk private credit.
Well, first off, thanks for having me. And yes, private credit is generally viewed as what I'll call non-bank provision of credit to corporates, real estate, and other structured finance opportunities. So without being a bond, so to speak, where you'd have a CUSIP, and without, again, coming from a regular way bank or insurer that would be funded either by kind of insurance premiums or bank deposits.
So let's talk about the kind of market conditions that have made this a really interesting and certainly very active space these days.
Yeah, I think it's really kind of a tale of two sides of the barbell, so to speak. Really, what you've had is since 2012, when a gigantic asset bubble was created by QE2, and since 2020, when that bubble began to kind of have air come out of it through profligate fiscal policy in many of the world's economies, you've seen this kind of barbell effect where on the right side of the barbell, throughout the private credit world, there was a huge amount of issuance in the kind of late 20-teens that was really kind of not necessarily well priced, well structured, appropriately compensated for, et cetera. And a lot of those things are now are involved with companies and assets that are going to have to be restructured. And there's going to be a lot of either existing obligations purchased at discounts or new issue financings within these special situations that are going to be very compelling. On the left side of the barbell, because of this kind of new environment because in a world with higher rates for longer, cap rates are going to be higher, valuations are going to be lower, there's going to be a new wave of issuance where the return per unit of risk on these various private credit instruments are going to be far more favorable than they've been during the time leading up to the kind of beginning of the fall in late 21.
And part of this, as you mentioned, is also happening because the banks have tightened up on their lending. And so a company that might go to their bank for a loan to get them where they need to be as a business are finding a tougher time sort of meeting that criteria. How big is that category becoming? Because we think, to your point, you mentioned kind of restructuring, distress, but these are companies that maybe the credit quality in a few years ago, certainly they would have had no trouble accessing financing through a bank. But now because of where we are, they have to turn to players like Arena.
Yeah, I think I would say in the wake of the GFC, banks were really severely restricted in many of the things they otherwise would have done. But if you look through it, regulators basically told banks, buy securities and do CRE lending, right? And so they went on the security side and went too long and exposed themselves to interest rate risk. And on the CRE side, they kind of overdid it. On the corporate side, we didn't see a lot of really overdoing of it, to be fair. And so I think the real opportunities arising from the kind of problems banks are now facing are more on the property side, whereas on the alternative side, you saw a boom in corporate lending that itself was pretty profligate, and therefore you're going to see new opportunities arising from the existing alternative space on that side.
What kind of rates typically are you charging these businesses looking for financing, and are you seeing an increase because there are more players entering the space, an increase of rate shopping by these companies?
I would say the relative return per unit of risk is generally inversely correlated with the size of the opportunity. Mm-hmm. So once you get into a situation where you're looking to borrow $100, $200, $300 million, there becomes a group of competitors that are very focused on the deployment of capital and are going to allow themselves perhaps to be rate shopped. If you are kind of below that 9-figure umbrella, the number of sources kind of reduces very significantly. And depending on the nature of the asset or the company you're seeking to borrow money for, you could see that at kind of risk-free plus anywhere between 500, 600 basis points all the way up to 1,000 or more. And keep in mind also, of course, risk-free is 500 basis points higher than it used to be. Mm-hmm. So that there is certainly an opportunity for sticker shock to some extent. But nevertheless, that's kind of the appropriate return that those obligations need to make in order to kind of justify the potential for default and the resulting severity that might come from a pool.
Dan,